Hello, everyone, and thank you for joining us today for our Chartered Insurance Institute webcast with Flaxman Partners. I'm Catherine Kennett, Policy and Public Affairs Manager at the Chartered Insurance Institute, and I would like to welcome you all to this session on liability insurance and limits of indemnity. How much is not enough? There are times when the adequacy of a policy's limits of indemnity are given scant thought. Roger and Michael will provide an overview of the factors to consider, including computing a suitable limit, claims from a common cause, aggregation, and much more. We have with us online today Roger Flaxman, Chairman and Principal Consultant, and Michael Wilson, Director at Flaxman Partners, who will delve into this topic in finer detail for you. There will be time for questions at the end of the presentation, so please feel free to use the question box you can see on your screen, and we will work through these once the webcast is finished. So without further ado, I'm going to hand over to Flaxmans.
Good morning, and once again, welcome to the Flaxman and Wilson Hour, as it was recently described by one of our regular viewers. I'm Roger Flaxman, and with me, as always, is the Venerable Michael Wilson. And our last webinar, which was just a few weeks ago, we attracted an audience of over 1,200 people, and we got more than 50 very, very good questions asked afterwards, all of which we've answered and sent back to the CII, so you can see the questions people were raising and the answers we've given to them. But one of them was a broker who'd listened to us about statements of fact, and they were just about to publish a statement of fact for their firm. And after he'd heard what we'd said, he decided it was decidedly the wrong idea. So he thanked us for saving his bacon. Well, we were very pleased to have been a help. Now, as most of you will know, if you're regulars, Mike and I spend our days reviewing and resolving disputed and complex claims. Now, we do this either in the context of advocacy for policyholders or as experts to the courts. And it's in this context that we become directly involved in the nitty-gritty of insurance policies and all the things that come out of them. And of course, that includes the amount of cover afforded by the policy. Now, you will all know that it's a fact of life that there's a huge amount of underinsurance around on property risks. But it's not so well known in our experience, talking to lots of practitioners, it's not so well understood that you can have an inadequate limit of indemnity on a liability policy. And we meet this increasingly. So the question is, why are liability policies sometimes shown to be inadequate limit of indemnity? Well, the liability limit of indemnity is required to pay not only the award or settlement of damages, but also has to pay the costs. And it has to pay the costs not just of the insured, but if the insured loses, in other words, if they're liable or if they admit liability for the purposes of a settlement, then the other side's costs follow. And so the amount of the limit of indemnity has to accommodate the damages and both sides' costs. And you would be surprised just how expensive those costs can be. So that's what we're going to talk about today. It's often a subject that isn't discussed. In fact, I would say from reading probably over 200 or 300 now, at least, witness statements on these kinds of things, very often in the declarations of the witness statements given by insureds and even by brokers, nobody really discusses the limit of indemnity under a public liability policy. They just say, well, you can have this limit or that limit, how much do you want to buy? But the reason for it is just often absent. And the purpose of this webinar is to give you a reason to say, actually, let's think about it a bit more closely. So with that, Mike, over to you.
Well, good morning, and thank you for that introduction, Roger. Just to run through today's learning objectives, to understand the meaning of liability, to examine what the limit of indemnity represents, to appreciate the erosion in the limit of indemnity by costs, something that Roger's already referred to review the factors to consider when establishing the adequacy of cover, and to consider how to assess the effectiveness of a contractor's liability insurance. So it's an interesting aspect that we know that a liability policy is based on legal liability, but quite often you'll come across people who assume that just because something has happened, then the liability policy has to respond. I had a case not too long ago on a home insurance where there was a problem between two neighbours, and one neighbour was complaining to our client that his trees or the tree roots had caused a problem to his drive. And our client had said to the neighbour, "Oh, don't worry about it. I'll get my liability insurance through my home insurers to sort it out for you," thinking that it was just like an ordinary insurance claim. But of course, what he hadn't appreciated was that they would only pay out if there was a legal liability. So, Roger, can you just go through these definitions that you've put on the slide here, just to get the ball rolling?
It should be fairly quick because you can read them quite easily. I'm just setting these terms out because, again, we know from experience that some practitioners and certainly most clients don't really understand what these terms mean. So liable means subject to an obligation of some kind or exposed to a possibility or risk or to be responsible for. Liability means the state of being liable. Legal liability is the state of being liable as defined by the law. And the state of being liable at law means having an obligation and responsibility by reason of the law, either the common law or the Act of Parliament, statute, or otherwise. So that's very simply what it means. Mike.
So Roger, we've also got a slide here which begins to help us engage with the problem of how we actually assess the risk. Could you comment on these points as well, please?
Yes. The principle, the objective here is you've got to put your mind to what the risk is all about. Now, it's incredibly difficult to be precise about this because by definition, every risk is different. But when you look at a risk, as we call it, first of all, is it a consumer risk or is it a commercial risk? And just think about it. How often do you hear of consumer liability claims reaching 100 million, for example? You know, it doesn't happen. 20 million, pretty rare. 1 or 2, 3 million, completely possible. The kind of damage that can be caused in the consumer context, for example, by tree roots or drains or something like that to somebody else's property, you could very easily cause a very substantial quantum of liability to an expensive house or to a building next door. So you've got to think of it in that term. When you're looking at personal injury, well, the sky's the limit. So you've got to take that into consideration. So when you look at the risk, you've got to use your own professional judgment, frankly, as to whether you think they are likely to be exposed to really large claims, and if so, why? Now, with regard to the law, you've got tortious liability, which is common law liability largely of negligence. Then you've got contractual liability, and of course there are occasions when the contract will limit the amount of liability, but that is subject to all kinds of caveats, including unreasonableness and laws concerning you can't contract out of personal injury liability, etc. So you've got to take that into consideration. And of course, you've got criminal and statutory liability, where the remedy is either imprisonment, penalties, or fines. And we're not insuring those. But you've got to take those things into account. And in the context of something like, for example, D&O insurance, you've got to work out whether a wrongful act, which is a breach of a statute, is going to attract a very substantial amount of damages. So that comes down to our professional judgment as to what these things mean. But the reason for putting them on here is to give you sort of a checklist to say, what do I need to think about? Now, the next one on here is the jurisdiction of the country in which the risk is located. Now, jurisdiction is much more important than you probably ever think, because it is increasingly common today for liability matters to emanate from somewhere outside the UK. And then you're coming back to a UK policy. The jurisdiction of the claimant will often have an impact on costs, and the jurisdiction of the policy, which would normally be UK law, will also have an impact on the costs. And this is a really complicated stuff, and I'm not going to try and explain it to you because it would take more than an hour. And actually, if you come across a jurisdiction problem of any kind, then stick your hand up, get a lawyer involved, because you won't be able to resolve it yourself. It really is complicated. Then we're looking at the known and the unknown factors concerning foreseeable and less foreseeable consequences, in terms of what I've said in here is money that may arise in the event of a legal liability. Now, money that may arise, I should have worded it differently, is simply damages, because damages are always in the form of money, almost always in the form of money. And so you've got to think how much money could flow from the consequences of this liability. And this is where, as professionals, we really do have the ability to say, well, what could go wrong here at the worst? It might not happen, but if it does, how bad could it get? When we're doing disputed claims and we're trying to help people to ascertain, what was reasonable to contemplate at the time of buying the insurance, this kind of discussion often hasn't taken place, because people say, well, how would I know? And the answer is, you are expected, or we are expected in the insurance industry, to have a better handle on that than our client, because we deal in insurance all day and every day, and they don't. So that's where we're coming from in here. Mike.
Roger, just to flesh out something that you've touched on. This is the type of claims that can arise under liability policy, because we probably automatically think of negligence, which may well be the majority, but there are three principal areas of claim. There's the tort of negligence, nuisance, and trespass. But there are other torts that have emerged over time that deal with harm or injury that is not otherwise dealt with by negligence, nuisance, or trespass. So, for example, we've got claims for defamation or products liability or some sort of economic tort. So the claims are perhaps a little bit broader than immediately spring to mind. Having gone through this slide and all these headings, the underwriter, of course, has got the job of deciding how is he going to price the risk. And of course, this last point refers to sort of known and unknown factors.
Less known. It's not so much known, it's foreseeable. It's not known, it's more foreseeable. What can you reasonably foresee with the benefit of experience of being an experienced insurance practitioner? You can probably foresee things that might happen more easily than your client can. That's the test.
So how does the underwriter decide how much he's going to charge for the risk? Is it mainly done on experience and statistics, or just a general feel for it? Because
I think you have to ask the underwriter, but I mean, it can only really be. I think it can only really be a combination of this is what we've had to pay in the past for these kinds of claims, and this is what we can reasonably foresee we may have to pay in the future. I mean, I think, for example, when you, and I know I go back to this a lot, but I think it's quite a good example. When we look back at the COVID, what I call the COVID claims, mostly the BI claims arising out of it, those quantums couldn't have been contemplated before COVID. Nobody would have foreseen that as a likelihood. Now that it's happened, you can say, oh gosh, we'll come on to that later when we talk about sublimits. But I think your answer to your question is that the underwriters probably all have slightly different ways of coming up with it. But obviously experience, track record, and their own professional judgment plays a large part in it.
Thank you for that. So, what's included, Roger? What's included in the limit of indemnity? I think you've touched on it, but let's just remind ourselves what exactly is included in the limit of indemnity. In other words,
it's the amount of money. The first thing that people think of is, could I be liable? If I was, how much would it cost me? It wouldn't cost me more than £1 million, so I'll buy £2 million worth of cover. That's normally the narrative. Or if there's a bigger, oh well, we ought to perhaps have £5 million just in case. That's often as far as it goes. It's very, very difficult, even for experienced litigators, to predict the outcome of a liability case until you know what the facts are. But what we all know, if you think of the context of a business interruption is the likely consequences of fire or damage stopping the business in its tracks. How bad can it get? Now, the recent case of Infinity Reliance, which we're going to be talking about, I think in October, we're going to do a bit of a show on that one, is a really quite a good example of how the consequences arising from a fairly simple event hadn't really been thought through, and you may say couldn't have been, although the judge rather thought that they could. The point about it is that if you stop and think, well, actually, what is this business? What are its dependencies? What are the things that it touches? And say to the customer, what are the things that would keep you awake at night? If you couldn't do this, what would the consequences be? Well, in liability, you can probably double the answer, because liability consequences can spread enormously wide, enormously quickly. And you'll get lots and lots of people say, oh, I've lost this and I've lost that and I've lost so and so. A lot of them might be false and they don't come to anything, but the expense of potential reach of damage in a liability claim is, I won't say infinite, but it's pretty wide. So the point about it, the limit of indemnity has got to contemplate the worst possible thing you can think is likely to happen in the event you have to pay damages. And that doesn't mean you're going to be found liable at court, because only about 5% of cases go to court. 95% will settle by some kind of mediation. So if you decide that your exposure to liability, let's say it's 20 million, from anecdotal experience, you can probably expect a settlement of something like somewhere between 50 and 60% of that. But don't count on it. Don't put your limit of indemnity down to that. Make sure there's a good margin. Now, the other aspect of it is the costs. And the costs of the defence of these claims are hugely expensive. But as we're going to come on to that in another slide, Mike, I won't do it now. We'll come on to it later. So it's the costs and the damages. That's what's included.
Roger, quite often, if you look at a policy schedule, it will state the limit of indemnity, for instance, £2 million.
Mm-hmm.
And it'll commonly say costs included.
Yes.
Now, if you said that to a policyholder who perhaps is not terribly well versed in these things, they would say, "Oh, that's good. It's cost inclusive. That's a real benefit."
Actually, it sounds like a benefit, doesn't it? It's not.
Yeah. So why isn't it? Why is it not?
Because the costs will come before the damages, and the costs can seriously erode the limit of indemnity. In fact, we had a case a couple of years ago where there was a 1 million primary and the 9 million over one excess layer, and the costs of defence exceeded £1 million before getting anywhere near settling on liability, the loan quantum. And that caused a big problem, which is one of the reasons it came to us, because the insurer said, well, I've exhausted my limit now, I'm going to walk away. And the excess layer insurer said, well, you can't. That was the dispute. And I can't tell you what the outcome is, but it wasn't good. And the point is that the amount of costs is actually the priority, because obviously costs will come before the result. So if you have a costs inclusive limit, you're actually a lot worse off. It means you have to buy more top-up layers if you feel that £1 million is going to be underinsured. And I'll just say this as an aside, in my experience and in my opinion now, I think for any commercial risk, I would not recommend a primary layer of less than 2 million, even if it's cost inclusive, because you really do need a fairly chunky sum of money at the bottom end to do the job of managing the claim. So a £1 million cost inclusive is pretty thin. So you might like to debate that and think about it, but I've seen it. Okay. I've seen it too often.
That obviously relates to the larger risk.
It does, yes. It does the larger risk, yes. Yeah.
Now, we've got an example here which you're going to go through, Roger, to do with a London restaurant, and it highlights the extent to which an indemnity limit can soon be eroded. Could you just go through the facts on this one for us?
I can. I'll just find my note on it so I know what I'm saying. Yes. Now, this was a London restaurant owner where above the restaurant there were other commercial businesses. And basically what happened was that the restaurant was very bad at keeping its hygiene going. And for, I think it was two and a half years or more, there were obnoxious smells, to say the least, coming from the flue vent, I've forgotten what the word of it is now, but the exhaust from the cooking. And it was going up through the chimney linings, and the linings weren't particularly well maintained, and they hadn't been cleaned properly. So first of all, you get quite a lot of contamination, and this started a dispute by the owners of or rather the tenants of the 2 floors above the restaurant. Then one day it caught fire, and that was it. And they had to move out, and it was really quite a serious claim. Now, it was hotly disputed. The claim was hotly disputed. But they incurred fees and disbursements over a period of, I think it was about 3 years, of 810,000 quid. And this was on a policy limit of indemnity of 2 million. So we're talking really quite a serious claim. And when you're looking at the limits of indemnity arising on these, it was just showing how close to the limit these can get. Now, what I'm going to say is that we've written for you a fact sheet on this, which is quite long and a lot more detailed than we're going to have time to go into this morning. So I think what we'll do is we'll just keep this moving, Mike, and come back to that if you have any questions about it later on.
I'd just like to raise one aspect on this before we move on, and that is that if I remember correctly, the broker was put under pressure because the limit of indemnity wasn't enough to both pay the claim but also pay the costs, not only the insurance defence costs but also the other side's costs.
Yes.
And I believe the broker was sued for not having provided more advice on the subject of fixing the limit of indemnity. Now,
it was, yeah.
I suppose it's fairly familiar territory for brokers to recognize that if they're advising on buildings insurance, for instance, there are relatively straightforward ways of advising the client to how to go about getting a valuation on a property to make sure that there's no underinsurance. But it's a more difficult matter for the broker when assessing liability, and
It is.
surely it can't be the broker's responsibility to fix the level of indemnity. So how
No.
can a broker go around the go about making sure that he's not putting himself on the line because it's not
Well,
always possible to predict these things.
no. I mean, I have to say, in this case, the broker was not found wanting, but they didn't stop them having a very protracted 2-year litigation. Because you see, the situation is this: it's not about the rights and wrongs of it so much, is that where there is a shortage of money from insurance, the lawyers will say, well, now sue the broker and just see how far we get. That's the language. It isn't whether it's reasonable or not. It's, well, they've got a pot of money there, so let's sue the broker. That's what happens. And in this case, I think the broker was able to show quite a good paper trail. And actually, that's what saved them. They did have a good paper trail. Now, the subject of how you assess a limit of liability hardly ever comes up. It's not something you see very often in brokers' records. It does occasionally, and I can think of 1 or 2 notable cases where it did, because it had to, because of previous claims. But it isn't something that most people discuss. But the reason for us doing this webinar is that we can see, as a trend, the liability claims, particularly at the bottom level, are increasing. And the costs, and this is the point, the costs of managing a small claim and a big claim are not very different, because legal costs are what they are, lawyers' time and costs. And if you think, all of us spend our life now on social media and emails, and do you realize that every email that is pertinent to a case will be taken into account by the lawyers, and they read them all? And if you've got 2,000 emails, they're charging for that. And that's where the money goes. It's an enormity of detail that is required to defend a case. And that's why the costs are going up. So it's not uncommon. In fact, Mike, if I were to say to you, just off the cuff, from your experience, our experience, the last 10 years, 12 years, what would you say you could reasonably expect for a modest sort of small commercial liability claim dispute? Oh, sorry, insurance claim dispute isn't going to be liability. What would you think costs might be?
I would have to anticipate something in the order of $250,000.
Yeah, quarter to a half million. It's not uncommon, is it?
That takes most people by surprise. But
We've got a case at the moment which was a £500,000 claim, and costs already up to 380,000. And the cost of taking the claim is, even if they get the satisfaction, it's going to leave less than £50,000 for the insured. This is really serious stuff. And that is a question. They're saying, well, what did the broker advise? Did they think about it? And what we're saying here is that you can't predict. You simply can't predict. But what you can do is to bring the subject up in some kind of dialogue to say, have you thought about how much you really need and why? And what we're trying to do is to give you a few pointers of how to have a discussion that you can then record to show that you've had the discussion and you've turned the client's mind to thinking about it rather than not. And I think at the moment, to answer your question, Mike, is about all we can reasonably do.
Okay. Well, moving on, we also recognise that another subject that isn't always discussed is claims that rise from the one common cause.
Yes.
And a number of policy wordings, and they're not all the same, but a number of policy wordings contain a definition of how the policy operates in the event of claims arising from the one common cause.
Yes.
So, for instance, you could have uh, multiple drivers damage their vehicles at the same pothole.
Yeah.
So this pothole has been ignored apparently by the council, and uh, you could have 50 or 100 vehicles all damaged by the same pothole, and the cause of the damage is the same, but the number of events, who knows? But it's the same cause. It's one pothole in the road that's done it all, and so therefore it's unlikely that in the context of a local council that there'd be a problem with indemnity limits, but it does illustrate the case. And in fact, we've got another example here, Roger, that perhaps you could take us to do with the famous metal bridges,
Yes. Well, this was
which
quite
I
a few
think
years
illustrates the point
ago.
quite nicely.
Yes, it does. This is a case of a design and construct contractor who delivered 30 metal bridges. This was overseas. And they were all designed specifically to carry heavy vehicles laden with agricultural materials. Within a year, one of them collapsed, and it was discovered that there was a design fault, which of course applied to all the other 29 bridges. So the claim was made against the contractor under their PI, who had a limit of £10 million any one claim and in all, plus one reinstatement. So that really effectively meant there's £10 million, and that included costs and expenses. So it was 10 million, including costs and expenses. And then there was a self-insured excess of £25,000. Now, in this policy, there was a clause which was basically saying that for the purposes of the insurance, all claims arising out of the same source or original event will be treated as
The
one
wording's
claim.
there on the slide. I've just put it up there. It's that wording at the bottom.
That's it there, yeah. So just take a moment to read that. Now, the cost of removal was said to be, at the time, something in the region of £250,000 each bridge, because they said that they couldn't rectify the design in situ. Now, that actually became a disputed point, but that was the point of the claim and why it went on for such a long time. And if you multiply that by 30 bridges, that comes to £7.5 million. And it was a £10 million policy, and that was before costs and expenses. So we got to a stage where there was a very, very substantial dispute about whether or not that policy was enough money. We then got to another problem, which was the excess of £25,000. Now, the whole purpose of that clause that we've read there was to contain the scale of the claim, particularly with regard to the excess. What the insurers said was that the clause meant, or was intended to mean, that each bridge was a separate claim and it didn't arise out of the same clause. Sorry, the same original cause. That was the insurer's contention. And eventually they won on that point. What was said was that had it been each and every claimant, we might have got a different answer. So the point we're making here is that if you look at a policy, if you were to sell a policy to somebody and say it's £25,000 each and every claim, and in the event you get 30 identical claims from the same cause, we're still going to charge you £25,000 each one. The insured would probably say, "I'm not going to buy it then." Now this is real. I mean, this is and it's not the first time we've seen it. So to bring it to your attention, the point about it is it meant that even if there was a limit of indemnity there, they had to pay 30 times 250,000 before they could even get an indemnity out of the policy. Mike.
Yeah, I think the point to recognise here is that the main concern with this wording is to make sure that your overall limit of indemnity is adequate, because some businesses are more likely to generate claims from a common cause than others. I mean, another example would be with solicitors, professional indemnity insurance. They would normally have a similar wording, and you might have a solicitor that has a common fault in its conveyancing process.
Yes. Yeah. Well, there was
Or, you know,
another case. Carry on. Sorry.
sorry, carry on.
I thought you finished. No. There's another case, if you remember, Mike, 2 or 3 years ago, which was to do with mortgage company. And a fault was found in their system, which was picked up by the FCA or FSA. I can't remember what it was. FCA, I think. And basically, this was a notifiable circumstance under a PI insurance. And the FCA said, well, we're going to do a review of your system, out of which it turned out that the same insured said, well, now you've said what you've said to us about your review, we have to notify that there are potential 1,800 more clients who had the same deal, and they had to notify those. And then that got into an argument as to whether they were each and every claim from the point of view of the excess and what limit of indemnity would apply. It was a really big fight. And the point of raising this is that it's very easy in our industry to put down some language like we've seen on the slide just before, but you've got to work out what it means in practice. And there's a lack of certainty, shall we say, as to what it means in practice. If you were to say to a client, there's a £5,000, £10,000, £20,000 excess each and every claim, were you to apply it to each and every claimant, would they buy the policy? Does it make a good deal? That's what we're trying to sort of highlight to you. Just think it through on that basis.
Just very quickly, we just need to race along a little bit. Just a comment about sublimits.
Yes.
Because quite often a policy will have sublimits for particular types of work. And quite often these are put forward as if it's a free benefit, something that the insured isn't necessarily looking for.
Yep.
So, for instance, we already made some reference to the business interruption losses, although that wasn't liability. A lot of the claims to do with denial of access, etc., had a sublimit. And there was no thought given to these sublimits until after the event. But on a liability policy, you might have, depending on the trade, you might have a pollution defence cost or a benefit to do with criminal proceeding defence or pollution costs. And quite often you might have a main limit of indemnity of 5 million, but these sublimits might only be £100,000. And it's really just a matter of reviewing the policy so that the insured can be aware as to what the cover is and what the sublimits are, so that at least the adequacy of those sublimits can be considered. So it's not just the headline limit of indemnity. But moving on, it's not unusual for there to be a requirement on a contractor to check the insurances of a subcontractor. So here it says it's a condition of this policy that you shall ensure that all subcontractors appointed by you hold a current public liability insurance which provides cover equivalent to that provided under this policy. So you can imagine a contractor engaging a subcontractor saying, well, I've got 2 weeks work for you. We'll start at 8 a.m. In the morning. Make sure you bring your own hard hat. And do you have insurance? Oh, yes, you've got insurance. Oh, that's good. Right, well, see you on Monday. And don't forget to bring your own radio. So you can just see that happening because sometimes it's very casual. And the main contractor in that case has said, well, I asked him if he had insurance. And he said, yes. Is that likely to be enough, Roger?
Well, we know that it isn't. first of all, just going back to the wording that we've got on the slide there, if you notice the word provide cover equivalent to that provided under this policy, i.e. the insured's policy, it's pretty much impossible for an insured to comply with that term, because you cannot tell a subcontractor where to buy their insurance or what their policy should say. And as every insurance practitioner knows, by definition, one insurance policy is different from another. They might be similar in those, but they are different. And as the litigation in the FCA proved without question, you only need slight nuances of wording to make an enormous difference in the way that the policy might be interpreted. So for an insurer to say you've got to make sure your subcontractor has an equivalent policy, it is just not possible to comply with, because the insured doesn't have that degree of control over the subcontractor. Now, the other aspect with subcontractors is this. In fact, we've got some of these cases on at the moment, so it's very much live in our portfolio. Subcontractors will always say, to get the job, oh yeah, right, I'll get that insurance, yeah, I've got that, yeah, I'll send it to you. If they don't, then the most you're likely to get is a to whom it may concern letter from a broker, which is not going to tell you very much about the policy wording, and you're not going to change that, because the received wisdom is that the subcontractor is not duty bound to tell his principal, i.e. the contractor, what are the terms of his insurance. All he needs to tell him is that he's got it. The question is it with a reliable insurer? Is it going to be renewed? Because some of it will be on a losses occurring, some of it will PI will be on a claims made basis. So you've got to think of those things as well. And will the sum insured be adequate? Will it be cost inclusive or cost in addition? And all of these things are not known. Now, some insurers say, look, do your best. In fact, we've got a case at the moment where the broker said, because the broker's being sued in this case, the broker said, well, I said to my client, just do your best. Now, that has been trampled all over by the lawyers on the other side, saying, well, what was the best? How do you define your best? What were you saying to them? Why weren't you more explicit as to what his obligations were? Because they're written into the policy. Why did you not tell him that? And the broker says, well, that's not what we do. We say to the client, you've got to get your sub, and we leave our client to do it. We can't do it for him. Now, these are the kind of disputes that create havoc in our industry. And what we're really saying here is, first of all, be aware of how little control your policyholder has over their subcontractor. And secondly, look at it on the basis that the reason for requiring it in the first place is because your insurer wants to have some prospect of subrogation if it's necessary. In our experience, the market or the industry could do with tightening up the way they manage this, so that they don't put their own policyholders in a position where they cannot comply with the obligation, because that's not fair to the insured. So that's the reason for bringing it up. Mike?
Roger, I wonder whether there's a need for an industry standard on this, because some public liability policies contain a certificate that's intended to be handed on to a main contractor. But even in cases where there's a certificate, the level of information on that certificate is a bit thin. So I remember an example where the main contractor was building an extension to a commercial property. And he'd engaged a subcontractor who had insurance. But what didn't come to light until too late was that the business description of the subcontractor's insurance said home improvements.
Yeah.
There was no reference to them building. So even just something as basic as the business description can make the whole arrangement unworkable. Whereas
Yes.
if the industry could agree a common form of certificate, a little bit like the employer's liability certificate,
Yeah.
that could be used containing common information, which at least would give the main contractor a fair chance of establishing that the cover's up to scratch. That might help
Well,
solve the
that's
problem.
absolutely right. And the other aspect that comes up too often is that the subcontractor has an insurance where their insurers say, but we do not indemnify you for liability arising out of contract. Now, the
Yeah.
point is the subcontractor by definition has a contract with the principal. So they've got no cover. So actually it's game, set and match, isn't it? And the point is it hasn't been thought through properly. And we're now in a situation where, as you say, it would make an awful lot of sense for some kind of industry standard to say this is what we're trying to do, I protect the subrogation right. That's all it really is for. And this is how we can do it. And this is, but don't put your insured in a position where they can't comply with your terms. I think that's our message.
Just before we move on to questions and answers, just a quick word about home insurance. A typical home policy might have a liability of a limit of 2 million. That's quite common. And is that enough? Because if it's not enough for a business policy, is it enough for a domestic policy? So some of the high net worth policies may well have a limit of 5, and so do other policies. But I don't think we should assume that all home policies have got enough cover. I'm not too sure what could be done about it because it's fairly standard. But particularly if the insured has got a large property or is situated next to a large property. We've already talked about the problems of tree roots and things like that.
Yes,
But
well,
also
warehouses. Yeah, go on.
Yeah, but of course, it's not just to do with the property that the liability cover applies to. It also applies to your personal activities. So you could have a family of enthusiastic cyclists who are conscious that if you do a lot of cycling, particularly if you've got the sort of bike that could easily travel at 30 miles an hour, there's a huge possibility of personal injury claims arising, and so for that alone, you might think that 2 million is not really enough to cover that bodily injury risk.
I think this is probably a matter for the industry to look at the statistics that it relies upon for setting the limit, and just think about whether it's worth, inflating it by 20%, 50% or something, because the marginal cost in these things isn't very great. The 2 million limit or 3 million limit, or even the 5 million limit, we're not talking of massive increases in premium. And it's a question really of just making sure that there is a sensible adequacy consistent with today's risk, not just of damages, but of the costs.
And finally, before we move on from this subject, our usual reminder that the cover you're looking for under most home insurances is the contents and not the buildings. I think we've commented on that before, but it's
for what reason,
easily overlooked.
For what reason? For what reason?
A claim to do with the property is going to come under the Occupiers Liability Act. And the Occupiers Liability Act, liability is covered under your contents policy and not normally under the buildings policy. I'm not talking about commercial policies. I'm not talking about buy-to-let, but the ordinary standard home insurance, for historical reasons, does not give much, if any, real liability cover under the buildings policy. It's almost always to be found under the contents policy. And so if you have clients who decide that they don't want to insure their contents, they need to be reminded that they're also denying themselves the liability cover, even if they're on their bike.
Exactly.
So with that, any questions?
Where's our hostess?
as usual, there's a range of questions from the examples, the excellent examples that you've been given. And the first one's quite a meaty one. It just says, what are the best arguments and ways for small or specialist subcontractors earning tiny fees on very large, complex projects to limit their liability? So the insurance limits and contractual, where employers are expecting unnecessarily high limits that far exceed any earnings. Just too many employers' principals try to kick the liability ball down the supplier chain onto smaller parties who perhaps have a weaker negotiation position due to size.
Yeah. Well, if we had half a day, we could probably do justice to answering that very good question. I simply can't give an answer of any value in the time available. The problem we have here, and I could speak for England on this because I'm pretty close to the subject nowadays, is that the contractual relationships in the construction industry are a nonsense for most of the people that are in the construction industry. And the reason for it is that the legal requirements, sorry, not the legal, the requirements in contract of the owner, i.e. the customer of the project, are such that they instruct their lawyers to pass every bit of liability away from them. So they pass it to the contractor then does the same thing to the subcontractors, and we have claim after claim after claim that comes along with this very problem. And the bottom line is that, and this is not me saying this, but other people say it, well, if these contractors want the job, they've got to take the rough with the smooth. And there's not an answer to this unless the contracting system is reviewed on some kind of proportionate liability. And that's been called for by lots of really intelligent and capable people at the top of the construction industry game for a long time. And I know quite a few insurers who've really struggled to say, well, look, come on, let's get some common sense into this. But whilst the construction industry is not interested, the developers are not interested, it would take some kind of law, and I don't know what kind of law it will be, but it's just very unfortunate. And I think the only thing I would say, and this is something I learned an awful long time ago from a lawyer from whom I learned a lot when I was a broker. I did a lot of work with this chap. And he said, sometimes not enough is enough, because they won't bother you very much beyond the limit of indemnity in your policy if you've got nothing to sue for. Now, that is pretty cynical, and I'm not giving that as advice, I can tell you, but you can see the context in the question you just asked. What can the contractor do? Well, make sure he's a limited liability company and buy a prudent level of insurance. And they're the two sensible things to do. A lot of contractors are not limited liability, in which case their house and everything else is up for grabs. So make sure it's a limited liability company, protect it, and then buy as much insurance as you can afford, and just pray.
Thank you very much. We've got another question saying, given the length of time which may elapse between date of injury and settlement, could you expand upon the impact of inflation of injury claim settlements and hence appropriate indemnity limits, please?
Well, that gets into all kinds of technical things, which I have to say I would not be the right bloke to ask on the technical arguments of if you like, the science and maths of it. But I think that if you would look at it like this, if you're buying liability insurance today, you ought to consider that your damages might not be payable for 10 years, and look at what inflation might look like over 10 years and use that as a benchmark. I mean, it's a judgment. It's just a judgment. There's nothing more to it than that. But there isn't any, to my knowledge, Mike, I don't know if you know any different, but I don't think there's any scientific way of looking at that. You've got to say, well, looking ahead reasonably, It might be 5 or 10 years before this comes to court, another 5 or 10 years before it gets settled. So what amount of indemnity would I need in that time? Certainly in my days of doing PI and DNO, that was the technique that we used. I was at Marsh for a long time.
I think Roger, the answer is
10 years
actually
ahead.
the answer is to be found in the question. In other words, it's a matter of being aware of it and making
Yeah, I
a
think it's
sensible
probably right.
allowance.
Yeah,
Because there isn't, I'm not aware of any scientific way of answering
no,
that.
nor am I. Good question. Any more?
Got another one saying if the cost source of expenses is very high for all types of liability claims,
Yeah.
why don't we as insurers, why don't we as underwriters to fix the expenses to, for example, 10% maximum of the overall policy limit? Is there any restriction not to do so?
No, but commercially you couldn't sell the policy because it might not be enough. And the insurance policy, you've got me on my hobby horse now. An insurance policy has got to fundamentally be a contract of good faith. And when you have a claim made against you, you want a defence. You don't want to think, I'll go to the cheapest lawyer. In fact, you won't be able to choose what lawyer you go to. The insurer does that. We'll go to a cheap lawyer because once they've racked up their bill, then I'm not defended. That doesn't work. What would make more sense is to make sure that costs are always in addition and price the policy according to the costs that you as the insurer know that you will incur on behalf of your client if they have a claim. And you take as an example, my example a few moments ago when I said there was £1 million primary, and that underwriter, who was one of the big boys, spent £1 million, and they got nowhere near settling the claim, but the costs were so ginormous. It was a really big claim. It was, it was a big construction-related thing. But if it was 10% of £1 million, £100,000, they'd have spent that before setting up the files. Never mind doing any deviling work on the claim. It just wouldn't work as a concept. Just look at the pricing. Say, this is what we're going to do. We will defend you, but you can't put a limit in it. No, sorry, not in my opinion. Other people may disagree with me, but that's my view. I don't think you could sell it in all conscience.
Right, there's lots of questions on regarding the examples, but please be aware, everybody, that although there are a lot of questions, they will be answered by Roger and Michael following this webinar. I'd just like to finish on one final question that says, to what extent are claims for pure financial loss admissible in law?
Well, that's an interesting question. The claim for financial loss is called pure economic loss. You can make a claim in pure economic loss, but it has all kinds of ramifications for proof, causation, and outcome. And it's not something that I'm going to give an opinion on here. But it's largely a matter that will be excluded from a very large number of insurance claims. So, if I knew more about what the questioner had in mind, we might be able to get closer to giving an answer. So if you want to write in with it and tell us what actually you're trying to find out, then we might be able to help you. But it is an issue. I'm well aware of that. Can I just say two things? First of all, that we have done a fact sheet. It's quite comprehensive, and it goes into more detail than we've been able to give today. So, and they are now available from us just on application through our website. And we are intending to run a live face-to-face seminar on the subject of infinity reliance, ourselves together with a couple of experts, because it's such a big subject and people are continuing to express an interest in it. So we'll do that sometime in October. So keep an eye open for it. And then if you want to participate in it, you'll have the chance. Should be an afternoon probably. Okay. Thank you.
Thank you very much from you both for delivering the webcast today and all the information shared. This session will also be now available on demand, and please feel free to share this with anyone that you think would benefit from it. Your CPD certificate and a copy of the slides is available to download from this portal. I just want to say a big thank you to all the delegates for joining us today. Goodbye.
Goodbye.
Bye.